Ladies and gentlemen, boys, girls, NBs, they, thems, mom and dad, how are you? So, this is going to be my second lecture of my neurodivergent analysis of the American collapse. If you didn't watch my first one, I did it on shareholder capitalism and neoliberalism. So for this one, I'm really going to start talking about the Federal Reserve, banking, and how money actually works. All right, so what are we going to talk about? So we're going to talk about the fact that the shareholder capitalism loop, it doesn't operate in a vacuum. It runs on a specific infrastructure that was built to support that. So the infrastructure like the Federal Reserve, commercial banking, the bond market, investment banking, and the architecture of national debt. Most Americans carry assumptions about money and banking that aren't true. It's not because they're, not smart. It's because the correct version is never taught and it's super vague and kind of hard to understand anyway. The incorrect version and understanding really just serves the interest of those who benefit from that confusion. So hopefully by the end, you're going to understand, like why quantitative easing made the rich richer, why national debt is someone else's asset, and the Fed is not what civics class told you. Okay, so what is the Federal Reserve? Fed, it's the hybrid institution that nobody really explains and everyone seems to have an opinion on. Okay, so here's what most people think the Fed is. They think it's the central bank of the United States, like the government's bank, the institution that controls money supply and sets interest rates in the public interest. It was created by Congress, accountable to the public, and it operates like a public utility. This understanding is kind of true, but also not. The full picture, it reveals a great deal about whose interests the institution was designed to serve. So remember, the Fed is not a government bank. It is not a private bank either. It's a hybrid institution whose public mandate and private governance produce systematic ambiguities about whose interests it ultimately serves. So it's private and public, and you seem to get the worst parts of both. Okay, how was the Federal Reserve even created? So it's the famous Jekyll Island meeting in 1913. It was created by Congress in 1913 following a series of severe banking panics. Its creation was the product of intense lobbying by the major banking interest of the era. The blueprint was drafted at a secret 1910 meeting at Jekyll Island in Georgia. Who was at that meeting? It was senior representatives of the largest American banks and the Treasury Department. The bill that ultimately emerged created the institution that was public in its mandate but substantially private in its structure and governance. This was not a coincidence. This is how it was supposed to be designed. Okay, so the Fed's actual structure, public mandate, and private architecture. So the Board of Governors, like the Fed chair that you see on TV sometimes, they're presidentially appointed, Senate confirmed. This is like the actual part that is public. There's 12 regional Federal Reserve banks. These are not government agencies. They are private institutions. Remember that. The regional banks are owned by the commercial member banks in their districts. So like JP Morgan Chase, Bank of America, Citigroup, Wells Fargo, etc. They're all shareholders of their regional Federal Reserve banks. And they receive the statutorily guaranteed 6% annual dividend on these shares in the Fed that they hold. These banks also elect a majority of the regional banks' board of directors. So the institution that sets American monetary policy is kind of controlled by the banks that it's supposed to oversee. Weird. Okay, so the independence question. The Federal Reserve is supposed to be independent, but independent from what? So it's supposed to be formally independent of the executive branch. So decisions are not supposed to be subject to presidential approval. This is actually kind of a good idea in my mind. So it's funded by its own operations. It's not funded by Congress. And the defense for this is monetary policy should be insulated from short-term political pressures, especially in the United States of America, when, national policy can change every 4 years. So it's a position with genuine merit. Like, I think, the president should not be able to control interest rates. That would just lead to hyperinflation. That would be horrific. So the Fed's leadership has been drawn overwhelmingly, though, from finance and economics, closely aligned with the financial industry interests. It's got a revolving door between the Fed and the major banks it supervises. it's one of the most well documented in Washington, D.C. So the question rarely asked is, if it's independent of politics, whose interests is it supposed to serve? And the answer of that is revealed mostly when, there's a national economic crisis in this country. Okay, so let's talk about how money is actually created. Okay, so most people, including myself for a majority of my life, believe that, you got money, right? And you're going to deposit that in a bank. And then the bank is going to loan that money to someone, and they are going to have to pay interest on that money so that the bank makes money. This is not necessarily how banks actually work. So it's not. It's wrong in a matter that is enormous, actually, because there's actually a 0% reserve requirement, and we'll talk about that in a second. Okay, so how is money actually created? It's fake. Money is fake. If there's anything that I want you to take away from this, it's that money is fake. So they don't lend money that they have. They create money out of nothing from issuing loans. I'm not making this up. So when a bank approves your mortgage and it deposits $400,000 into your account, that $400,000 did not exist before it was approved. So the bank is basically just making it out of thin air by punching some numbers in. So on their books, you have a mortgage obligation. You owe them $400,000 plus interest. And the liability on their balance sheet is that deposit in their account. So that $400,000 that you're going to buy a house with. The money just appeared out of thin air the moment that the loan was approved. And this is confirmed explicitly by the Federal Reserve and the Bank of England and every serious academic treatment of monetary policy. So just know that the money is not taken from savings. It does not exist before a loan is made. It is created from nothing by the act of lending by a private profit-seeking institution directed by its own financial interests. Let's talk about fractional reserve banking. So this is what we talked about, where the money doesn't exist and then they loan it out and it exists out of nowhere. This is called fractional reserve banking. In theory, banks must hold a fraction of their money as reserves. However, in practice, they don't really have any fractional reserve requirements. In March 2020, it was dropped to zero. So banks are constrained in money creation primarily by the capital requirements and the demand for creditworthy loans. So there's no vault somewhere that's just full of dollar bills. Like I said, it's just created from nothing. Money is fake. So private commercial banks, profit-seeking corporations, etc., they determine through lending decision where new money flows. They create money for mortgages, corporate loans, auto loans, credit card debt, etc. They do not create money for public infrastructure, wages, or social needs. They are interested in profit and making money. So the direction of money creation is a political economy decision that is made by private institutions in their own financial interests. Let's talk about interest rates. So we talked about the Fed, what the Fed kind of is, and fractional reserve banking. So we're going to talk about interest rates, which are the Federal Reserve's primary lever for controlling inflation. Okay, so the interest rates are the Fed's primary lever for controlling inflation, which is the federal funds rate. It's the baseline interest rate for the entire economy. So every time that you encounter an interest rate, it can be tied back to this number. So your mortgage rate, your car loan rate, your credit card APR, if you have a savings account, this is the interest rate, like the top interest rate. So the rate the corporations can borrow to hire or buy back stock, and it's also the rate at which the government borrows by issuing treasury bonds. So one committee meeting 8 times a year sets a number, and that number ripples throughout every financial transaction in the country. Okay, so let's kind of draw a picture here. So if inflation is high, and we'll do inflation is low. So when inflation is high, there's too many dollars chasing too many goods, right? So what the Federal Reserve will do is they will increase interest rates, and this makes borrowing money more expensive, right? Because if you have a higher interest rate, you're going to pay more in interest. So this, in theory, lowers the amount of money in circulation. So decreases money in circulation. Now, when inflation is low, right, they might lower interest rates because they have to balance employment and inflation. And we'll talk about their dual mandate here in a little bit. But when inflation is low, they can lower the interest rate, which makes borrowing money cheaper. So, if you wanted to buy a mortgage when there's low interest rates, you might get 4% mortgage. So when they lower interest rates, it makes borrowing cheaper and it increases the amount of money in circulation. All right. Like I said, the federal funds rate is the top interest rate that controls all of the other interest rates. But what actually is it? So the federal funds rate, it's the interest rate at which banks lend money to each other overnight. So it's the overnight federal funds rate. So at the end of every business day, some banks have excess reserves, some have insufficient reserves. So the banks with excess, they'll lend to banks with deficits overnight, and it will be repaid the next morning. The Fed influences this by buying or selling treasury bonds in the open market. So when the Fed buys bonds, reserves increase, banks have more to lend, the overnight rate falls. When the Fed sells bonds, the reserves decrease, banks have less to lend, the overnight rate rises. So this mechanism of buying and selling bonds to influence the overnight rate, it's called open market operations, and it's the Fed's primary day-to-day monetary policy tool. Okay, so how rate hikes cascade through the economy. So banks' costs of borrowing rises when interest rates go up. It makes it more expensive for everyone in terms of loans because the interest rates go up. Variable rate debt reprices immediately. Credit cards, adjustable rate mortgages, etc. Fixed rate borrowing prices more out of reach, and fewer people can afford mortgages when the interest rate is up because borrowing is more expensive. So bond prices might fall, they might climb. Existing bonds that you hold are worth less. Stock prices tend to fall when interest rates go up because future earnings are worth less now. Small businesses can't afford to expand on credit, and the dollar strengthens as foreign capital starts flowing in. So rate cuts, on the other hand, so cheaper loans for mortgages, cars, businesses, the variable rate debt gets cheaper. So like your credit cards, adjustable rate mortgages, more people can afford to buy homes. Businesses can afford to hire and expand. Bond prices rise. Existing bonds are more valuable. Stock prices tend to rise. Dollar weakens. Exports become more competitive, and economic activity accelerates via cheap credit. But when interest rates are low for an extended period of time, like say almost 0% for 20 years, it's going to lead to higher inflation. Gee, I wonder if anyone has been experiencing that lately. Okay, so let's talk about the dual mandate. Okay. So, from Congress, the Federal Reserve's dual mandate is to maximize employment and stabilize prices. But the problem is these kind of work against each other. So maximum employment is to keep unemployment as low as possible without triggering excessive inflation. So stable prices is their other mandate. They want to keep inflation at approximately 2% annually, which I don't think has been a thing for quite a few years now. So the tension between these goals is they often pull in the opposite direction. So like, let's say that that inflation is high. What is the Federal Reserve going to do? Well, they're going to increase those interest rates, which makes borrowing money more expensive. So, businesses and stuff, they have less money on hand. So this actually leads to higher unemployment. Okay. Now, the exact opposite is true. So when inflation is low, they will decrease interest rates, which will lead to lower unemployment. Okay, so unemployment and inflation, they work against each other just based on how money works. It's made up anyway, right? Okay, so let's talk about who benefits from rate decisions. Okay, so when rates get hiked or interest rates go up because inflation is high or something like that, the people with variable rate debt are disproportionately hurt by rate hikes because they have lower and middle income. So now, if they have credit card debt or whatever, they are going to pay higher interest rates on that debt. And people that are wanting to buy homes, they get locked out by unaffordable mortgages because the interest rates on those mortgages go up. Workers are also hurt because hiring gets slowed, and small businesses that are dependent on credit can't borrow money because it's now more expensive, so they can't afford to invest in their business. Now, the people that are largely protected are people that own their homes outright. They don't have any exposure to interest rates. People with significant financial assets like bonds, they're going to appreciate in yield terms. Large corporations with existing loan terms or long-term fixed rate debt, they're going to benefit. And cash holders, the purchasing power of savings increases when rates get hiked. And the people who bear the cost are disproportionately those with the least financial cushion. So, normal people. Now let's talk about NAIRU. So, non-accelerating inflation rate of unemployment. It's a mainstream economic concept, and the idea is that there is a minimum level of unemployment below which inflation will inevitably accelerate. So when unemployment falls below this level, workers gain enough bargaining power that wage growth will exceed productivity growth. The Fed uses this concept to explicitly or implicitly set a floor on unemployment. So like when unemployment drops below that number, they're going to start, messing with rates because otherwise it might have an impact on inflation. So a certain number of people being unemployed is not a tragedy to be solved. It is a feature of how our economy is designed. This is not fringe or radical. This is just a thing that happens in every economics department in the country and other countries that are largely capitalist in nature. So in plain terms, the Fed's inflation-fighting mandate structurally requires maintaining a pool of unemployed workers large enough to prevent wages from rising too fast. So unemployment is the mechanism. Workers' reduced bargaining power is the intended effect. This is mainstream macroeconomics, stated plainly in most macroeconomic textbooks, and almost never stated plainly in the political coverage of the Fed. So let's talk about like 2022, 2023. There was a lot of inflation going on. So this was a byproduct of supply chain shortages and the world economy growing or restarting. This was not limited to the United States of America, by the way. This was literally in every economy in the world. And America actually fared pretty well. So between March 2022 and July 2023, the federal funds rate rose from near zero to over 5%. The goal was to bring inflation down from its peak of over 9% annually towards that 2% target. So in Jackson Hole in August 2022, Jerome Powell, he said that bringing inflation down would require below-trend growth and some softening of labor market conditions. So softening of labor market conditions means that unemployment is going up. They acknowledged that this was going to bring some pain to households and businesses, and the hikes actually did reduce inflation. And by the way, 5.25% where the federal funds rate was at is like nothing, considering like I think it was the 80s, Paul Volcker raised interest rates to like 15%. So interest rates in the housing market. So if you're Gen Z, you're very familiar with the fact that housing is basically unaffordable. So the monthly mortgage payment is determined by two things: the price of the home and the interest rates. So like during the 2010s, when instead of, I don't know, being in like middle school, you should have been investing in real estate, because near zero rates made super cheap mortgages. But this also had the unintended effect of, like, all that cheap money for so long, it drastically reduced the housing supply, which made housing costs double. It's really cool. It's all stupid. It's made up. Like I said, money is made up. So existing homeowners who are locked in 3% mortgages don't have any incentive to sell, right? So inventory stays low, prices stay high. New buyers face both high prices and high rates simultaneously. And older, wealthier homeowners, their asset values are protected, and their housing, the wealth that they have in their house, it goes up. Well, younger people like me kind of get closed out because it's expensive and unaffordable. So interest rates and asset price connection. So why the wealthy watch the Fed so closely. Now, if you are a woke libtard snowflake like me, you only watch CNN. That's actually a joke. The only my main news source is really just like the Financial Times, because if you understand like that everything is ultimately the economy and how money works, like the Financial Times is really good because that's the newspaper that rich people read. But let's talk about asset prices and stocks and interest rates and stuff like that. So a quarter of a point rate change in that federal funds target rate, it can move stock markets by trillions of dollars. Here's the reason. So like when rates are low, the present value of future earnings is higher, so stock valuations rise. Bond yields are low, so investors move into stocks seeking returns, because when that interest rate goes down, the yields on US Treasury bonds go down as well, and stock prices will rise. Borrowing is cheap. Companies can, use the cheap money that they have to buy back their stock, which artificially raises stock prices. And when rates rise, these relationships are the reverse. So a rate cut announcement, it can add trillions of dollars to the collective net worth of asset holders within hours. And a working person with no financial assets beyond a paycheck, they're basically unaffected by the same announcement. The Fed's decisions are monetary policy for everyone, but wealth policy primarily for those who actually have wealth to manage. Now, if you have, like, I don't know, $50,000 in your 401k, you ain't in the club, big dog. It ain't you. You're not that guy. Okay. One of the other ways that the Federal Reserve controls monetary policy in this country is through what's known as quantitative easing and quantitative tightening, or QE and QT. So let's talk about what QE and QT actually is. Okay, QE. So in response to the 2008 financial crisis, the Fed undertook a program called QE. It repeated in 2020. The combined effect was one of the most consequential redistributions of wealth in American history. It received a fraction of the political attention devoted to debates about, food stamps, welfare, social spending, and all that stuff. So let's talk about QE. Okay, so you remember how, like, I said that banks create money by loaning it out, but the money doesn't really exist and they just kind of make it up? Well, the Fed does the same thing. All right, so the Federal Reserve creates new money electronically by adjusting its own balance sheet. It uses that newly created money to purchase financial assets from banks and financial institutions. So like in the 2008 housing crash, there was a shit ton of like useless mortgages that were never going to be paid back. The Federal Reserve created money out of nothing and bought these useless assets. So the immediate effect of this was it flooded the banking system with liquid cash, which could suppress those interest rates and stabilize collapsing asset values. So when you see the Fed is increasing their balance sheet, so when they add to their balance sheet, they are buying assets, which injects liquid cash into the market. Liquid cash that didn't previously exist. Now, this money didn't go to, you and I, like, what, you been to Epstein's Island or something? No, dog. Like, it didn't go to households. It went to financial institutions that were holding financial assets. So the Fed created trillions of dollars. These dollars went to financial institutions that held financial assets. These financial assets are owned by the wealthy. So the math of who this really benefited, it's not complicated. It benefited wealthy people. So, who QE actually helped? So, by purchasing these financial assets and suppressing interest rates, the Fed dramatically inflated stocks, bonds, real estate, whatever, because they are injecting that liquid cash into the market. So, these are assets that are owned overwhelmingly by wealthy individuals and institutions. The bottom 50% of Americans own basically no stocks. And this gap is getting bigger, widening. So I think it's like the top 10% of wealthy people in America now control like 90% of all assets or something like that. It's ridiculous. So between 2009 and 2019, U.S. household wealth increased approximately by 60 trillion, the vast majority of which went to the top 20%. Very, very cool stuff, right? So this wasn't intended to produce inequality. It was intended to stabilize the financial system in 2008, which was bordering on global catastrophe. But financial system is owned by the wealthy, so stabilizing it, it benefited the wealthy. I know it's quite shocking to hear that. Okay, so who QE got hurt? Who QE hurt, right? So we already know that stock owners, real estate owners, and bondholders and corporate executives with stock compensation, QE helped them quite a lot. Now, people that got poorer relatively were the savers with bank accounts, because also with this QE, they dropped interest rates to near zero. So your savings account was not really generating any interest payments. Retirees on fixed incomes and CDs, so certificates of deposit, people who were renting while home prices surged, workers with no stock exposure, and just savers in general, people who saved instead of speculating on assets. Like I said, if I wasn't in second grade like a dumbass, I should have been investing in real estate. Okay, so that's QE. So QE, they buy assets, and that injects money into market. So what do you think QT is? Okay, so QT, quantitative tightening, QT, they sell assets. People buy those assets, and by people, I mean banks and really, really rich people, and that basically just deletes money out of the market. So it removes that liquid cash from market. Okay. So, like in 2021 and 2022, partially as a consequence from the QE and zero interest rates and all that, the Fed faced the question of what do they do with their $9 trillion on their balance sheet, and they engaged in QT. So they shrank their balance sheet, and they sold the assets that they had to banks, rich people, governments, whatever, and removed all that money from the money supply, which did help lower inflation. So if QE is like the flood, QT is the drain. Okay, so quantitative tightening, like I said, it's they have two different ways. So they have passive runoff. So when bonds and mortgage-backed securities that the Fed owns matures, the Fed does not reinvest the proceeds. The money just leaves the system, their balance sheet shrinks. And then they have active sales, like I said. So this is when the Fed sells assets into the market before they mature. It's more aggressive and more market disrupting. The Fed has primarily used passive runoff, which is slower and less disruptive, but the effect of either is that the reserves drain from the banking system, money comes scarcer, and there's upward pressure on interest rates, and the financial conditions kind of tighten. So QT works in the same direction as rate hikes, just through a different mechanism. Okay, so 2022 and 2023 was the most aggressive tightening in decades, and rate hikes and QT was running simultaneously. So why is QT harder than QE? So they're not symmetric operations. Undoing QE is a lot harder. So QE works by just making money, which is already made up, and the effect is like immediate and powerful. Well, as QT, it drains those reserves of that liquid cash, and the transmission is slower, it's less predictable, and it's more prone to sudden dislocation. So financial markets have adapted to like years, decades of like free money, and they got used to it. So institutions and strategies and pricing models that were built around, the assumption that money would be free for forever, when that liquidity goes away, the models start breaking down. Institutions face stress in ways that they didn't really think about until it started. So the Fed is trying to quietly deflate the balloon it rapidly inflated, but balloons don't always, deflate quietly, right? So you can flood a system in weeks, draining it takes years, and you don't know you've drained too much until the plumbing stops working. So what does QT do to asset prices? So QE, it inflates asset prices by flooding the financial system with liquid cash that had to go somewhere. So those reserves flowed in stocks, bonds, real estate, inflated valuations, money was free, inflation, all that. QT reverses the flow. It drains reserves. It reduces the pool of money chasing financial assets. So the theoretical effect is that asset prices should fall as QT proceeds, reversing some QE gains. But the practical effect of this is it's more complicated than that. Asset prices don't necessarily decline smoothly. They hold until they don't, and then they adjust suddenly and severely. Like the 2022 bond market was one of the worst years in history, so holders of long-term treasury bonds lost more than 30% of their value. The same bonds that the Fed had told the market were the safest in the world. Who gets hurt by QT? So QE primarily benefited asset holders. Does QT reverse that benefit symmetrically? What are you, born yesterday? Of course not. Wealthy asset holders have the staying power to hold through a downturn and recover. Working people who bought homes at peak prices, they face immediate and concrete consequences that do not reverse. The underwater homeowner who bought at the peak does not recover just because the Fed, pivots. The small business that failed when credit became unaffordable does not just reopen when rates come down. If you lost your job because of the cooling of the labor market, you don't get those wages and seniority back. So QE gains, largely permanent for those who captured them. QT losses, disproportionately permanent for those who are least able to absorb them. Capitalism, baby. It's great. Let's talk about the 2019 here for a sec. So in September 2019, before COVID, the Fed had been running a modest QT program, gradually shrinking from its post-08 peak. And without warning, the overnight repo market, the market which banks, lend their reserves to each other, it kind of backed up and stopped working. So overnight lending rates spiked to nearly 10%, which was 5 times the Fed's target. And the cause of this was reserves had drained well below what the financial system needed to function smoothly. So the market didn't really send any clear signals in advance. It just stopped working one morning, and the Fed immediately had to reverse course. They had to inject hundreds of billions of dollars in that money that was fake and printed. And the lesson of this is there's no reliable indicator of how much drainage the system can absorb before everything just falls apart. The threshold was invisible until it was crossed, and in 2019 it was crossed with the balance sheet still above $3.5 trillion. All right. So in 2023, if you don't remember, there was kind of a little bit of a banking crisis, not really among like institutional banks, but certainly among smaller regional banks. So like Silicon Valley Bank, it collapsed. This was the largest U.S. bank failure since 2008. So Silicon Valley Bank had loaded its balance sheet with long-term treasury bonds during the QE era of like near zero rates. So, when inflation picked up in that post-COVID era, the market value of the bonds that Silicon Valley Bank was holding were junk. So SVB, they sat on massive unrealized losses. And when they realized that depositors, they engaged in a bank run, and the bank basically failed to exist within 48 hours. There was two other banks, Signature Bank and First Republic. They all failed kind of within the same period. The Fed and FDIC responded by guaranteeing all deposits, including those above the $250,000 insurance limit. So the 2023 crisis was a direct consequence of the rate environment that quantitative tightening helped create, and it resolved by expanding the guarantees that create conditions for the next crisis, which we are experiencing right now. Okay. Let's talk about the Fed's current dilemma and the trap that it built for itself. So they dug their own grave, basically. It can't easily continue quantitative tightening. The risks triggering financial system dysfunction, like in 2019, 2023, it can't easily stop QT because it risks signaling balance sheet will never return to pre-QE levels. It cannot easily restart QE because we exist in kind of an inflationary environment. So the risks might just reignite inflation that it's been trying to deal with for, going on like my entire life. It can't raise rates further because that would risk a recession and additional banking sector stress. Every tool that they use creates a new problem. This trap is a product of 15 years of extraordinary intervention that was never designed to be permanent, but became like structurally embedded. So a series of individually defensible short-term decisions that collectively produce long-term dependencies. Like you can't put the toothpaste back in the tube. It's really hard to do that. They didn't design it intentionally. It responded to, individual crisis, one that was reasonable in isolation, but it produced this system that is now basically dependent on the Fed to be weaned to it, if the Fed is, selling heroin, well, the banking industry just got addicted to it and they can't stop. So what do QE and QT kind of reveal about the system in general? Well, when asset prices were collapsing in 2008 and 2020 that threatened the wealth of capital holders, the Fed intervened immediately and at an extraordinary scale. When inflation was eroding purchasing power of wages and savings, threatening working people, the Fed raised rates, which in turn cooled the labor market and, ended up in a lot of people losing their job. So asset price collapse was met with immediate unlimited intervention of free money and money printing. Wage inflation that reduces real returns on capital were met with rate hikes that were, that just increased unemployment. Both of these responses are framed as neutral technical policy. Both of these consistently prioritize the protection of capital over the protection of labor. This is not a coincidence. It is the revealed preference of an institution whose governance and philosophical foundations are aligned with the interests of capital. All right, so QE, QT cycle, and the US dollar, why this goes global. The QE and QT cycles do not stay within the American borders. They ripple throughout the entire planet. When the Fed conducts QE, suppressing US rates, capital flows out seeking higher return in emerging markets. That flood can inflate asset bubbles in developing economies and create dependencies on continued dollar flows. Now, when the Fed tightens and they raise rates and conduct QT, that flow reverses. Capital rushes back into the United States. It drains from emerging markets, which can cause their currencies to crash. It can cause debt crises. So like the 2022 rate hike cycle, there was a couple currency crises and debt distress all across Sri Lanka, Pakistan, Ghana, Egypt, and others. This also happened in the UK. So countries that borrowed dollars cheaply found their debt burdens multiplying as the dollar strengthened and their currencies collapsed. This is happening in Japan right now. The Fed made a domestic monetary policy decision, and every country around the globe, basically experiences it as economic catastrophes. Okay, so that's the Fed, that's QT, that's QE, that's interest rates. Holy crap, that was a lot. But here's like the thing that I want you to remember. So inflation, let's draw inflation here. Down here, let's draw it twice. All right. So when inflation is going up, usually unemployment goes down. Okay. When inflation goes up, unemployment goes down. when inflation is going down, unemployment usually goes up. Goes up. Okay. So inflation is high. There's a lot of dollars in the economy. Unemployment usually goes down because businesses can afford to hire more people. People can get higher wages, whatever. So how do we fix high inflation? Well, there's the QT and raising interest rates. So when interest rates are raised, the price to borrow money is now more expensive. People are borrowing less money. There's less money going into the economy, which means that unemployment will usually go up because businesses are not hiring people. But they can also engage in QT, which is that quantitative tightening. And that is when they are selling their assets, on their balance sheet, which deletes money from the economy because, they're selling assets to wealthy people, banks, financial institutions, whatever, because they want to get the interest rates on whatever assets the Fed is holding. So they give the Fed the liquid cash they could otherwise spend, and this deletes money from the money supply. The exact opposite is true for low inflation, high unemployment markets, right? So when inflation is low and unemployment is going up, they can drop interest rates. So when they drop interest rates, it's cheaper to borrow money. You can hire more people, whatever. Unemployment goes down, inflation goes up, but they can also do the QE, which is when they print money or create money out of thin air to buy assets. And those assets will sit on the Federal Reserve's balance sheet, and that liquid cash that they otherwise would have gets injected directly into the economy. Okay. That was fun, right? Okay, now let's talk about the national debt and who actually owns it, because I swear to God, no one actually understands how the national debt works. I definitely don't either, but it's the most weaponized, least honestly explained concept within American politics as a whole. You got the deficit hawks, you got, people that say cut spending, got to pay down the debt, whatever. Let's talk about it. Okay, so let's talk about what most people understand about the national debt. So the national debt debate in American politics is almost entirely framed around whether it's too large. The question is never asked who actually benefits from it. The interest payments on the debt go somewhere, so following them is rather revealing. So politicians will invoke the national debt constantly, especially during election years, as a moral failing and a burden on future generations. I'm not advocating for the national debt that needs to go up. I'm telling you how the system works in the way that I understand it to work. So the household budget analogy is deployed endlessly, right? Like, if a family can't spend more than it earns indefinitely, neither can a government, right? Like, if you have a spending problem, you got to cut spending. If you're going into credit card debt, whatever. It's very different, and it's different in ways that matter like enormously. Okay. So a household doesn't create the currency in which it is indebted, right? The US government issues treasury bonds, and the US government issues the dollar. So you as a person, if you're in credit card debt, you can't just create more money to get yourself out of debt. The government can, okay? So a household can't compel the rest of the world to hold, onto its debt as reserve assets. Meanwhile, US Treasury bonds, well, for a long time anyway, are the world's primary reserve asset. That is definitely going away now. They're not minor technical differences. There are structural differences that make this analogy misleading and kind of harmful, because it doesn't really allow people to understand how the system works. Again, I'm not defending how the system works. I'm just telling you how the system works in general. I'm not saying it's good. What is the national debt? Who actually owns it? What is it? Okay. So the national debt is the accumulated total of US Treasury bonds issued and outstanding. Okay. So when the government spends more than it collects in taxes, it issues Treasury bonds, IOUs that pay a fixed interest rate. Okay. So you might have treasury bonds in your 401k. You can buy them, but a lot of the national debt is just really misunderstood in who owns it and how it works. Okay, so 25% of our debt is held by foreign governments and institutions. Historically, it's China and Japan. 25% is held by the Federal Reserve itself as a result of, the QE, or quantitative easing. And about 50% of the national debt is actually owned by Americans in the form of institutions and individuals, pension funds, insurance companies, mutual funds, banks, wealthy investors, your 401k. Does that make sense? Okay, so let's kind of draw a picture here. So when the US government, USG, when they want to spend money on developing missiles for the Defense Department, the US government wants missiles. But the problem is the US government has no money. Okay, the US government, it wants missiles, it doesn't have any money. So the US government, through the Department of the Treasury, will sell bonds, okay? So sell bonds. And these bonds will have like a fixed interest rate. And this is also kind of tied to the federal funds rate that I was talking about, okay? So the government will say like, hey, if you buy our bonds or our debt, we will pay you 5% interest, okay? So someone buys, buyer, and we have a buyer, and then they will collect interest on that debt. So again, I want you to keep in mind the other thing too is like when interest rates go up and interest rates go down, it's going to have a dramatic effect on the bond market. The bond market is also very, 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 very sensitive to geopolitical affairs and domestic stability. So like when the bond rate goes up, so bonds go up. So if the bond interest rate goes up, it means that investors want more money, or they want a higher interest rate for the money that they are giving you because they don't believe in you being able to pay it back. So lack of faith. And when bonds go down, there's a lot of institutional trust. Lots of faith. So I remember a couple months ago, Scott Bessent, the Treasury Secretary, he posted on X, formerly known as Twitter, the Everything app. He said that like the bond market has the highest rates that it's ever had, and he said that as if it's a good thing instead of people losing faith in our ability to pay back debt and wanting a higher interest rate. Does that make sense? Okay. So the interest rate payment transfer, what this means. Okay. So the national debt is a mechanism through which tax revenues collected broadly from the population are transferred as interest payments to the people and institutions wealthy enough to hold significant amounts of treasury bonds. Okay. So every year, you pay taxes. It's super fun. You gotta give Middle Eastern foreign countries between Egypt and Jordan and $11 billion a year. And every year it's going to pay interest on those bonds to whoever holds them. So say that Japan has a lot of bonds and the US government owes interest on those bonds. Your tax dollars are basically going to Japan in the form of interest payments. So at the current debt levels and rates, like our interest payments are basically like, I think it's more expensive than Social Security and Medicare at this point. I'm pretty sure it's the most expensive part of our budget. And the recipients of these interest payments are usually large financial institutions, pension funds, insurance companies, foreign central banks, and wealthy individuals. The ordinary working person, you don't usually meaningfully own a lot of treasury bonds. You can buy them. It's kind of a pain in the ass though, but if you have a 401k that's actively managed by like Fidelity or Vanguard or whatever, usually you'll have some treasury bonds in there. But I mean, the difference between your $50,000 in your 401k and, a country like China owning, $100 billion in American debt Very, very different, right? Okay, so they pay in, the interest payments go out to the capital holding class. This is not a conspiracy. This is literally just how it works, okay? So your tax dollars go to service the debt for money that you don't even benefit from. It's really, really cool. Okay, so that's the Federal Reserve and the national debt. Now let's talk about investment banking, private equity, and the revolving door. Okay. So it's like a tier, right? So you have your local bank, you have commercial banks, you have investment banks, you have the Federal Reserve at the very top, okay? So investment banks, like Bear Stearns was an investment bank, right? Investment banks don't take deposits and make loans traditionally. They arrange mergers and acquisitions, so they buy and sell entire companies. They underwrite securities offerings. They bring stocks and bonds to market. They structure complex financial instruments. They manage large pools of capital for institutional and wealthy individual clients. And they operate as principals in financial markets. They bet against their own capital rather than just serving as intermediaries. They run the casino and they also play in the casino. It's really, really cool. Okay, so this actually does matter. So like an intermediary, which these are kind of supposed to be, they serve the clients that they're supposed to serve, while as the principal, it serves itself. Let's talk about Glass-Steagall, okay? So I don't remember what happened in the 1920s and 1930s, but something must have happened because they passed the Glass-Steagall Act, which separated commercial banking from investment banking. The reasoning was that combining deposit taking with speculative financial activity, it created catastrophic conflicts of interest and systemic risks. Oh, that's what happened. This basically is what led to the 1929 collapse and the Great Depression. This separation was maintained for 66 years, okay? And then we have our favorite neoliberal woke communist, Bill Clinton. He came in 1999, the year that I was born, and he repealed it with the Gramm-Leach-Bliley Act and signed it, and it basically deregulated the financial industry again, okay? This was one of the most consequential pieces of financial deregulation of the neoliberal era. So the people who lobbied the most aggressively for its repeal were Citigroup and the most major investment banks. And then, not even 10 years later, they got themselves in trouble again and collapsed the entire housing market, which collapsed the entire global economy. Great stuff, ladies and gentlemen. Great, great stuff. Okay, so that's investment banking. Let's talk about private equity. So private equity like Blackstone. Private equity firms, right? So private equity firms, they raise money from institutional investors. This is not, you with your $50,000 in your 401k who wants to invest. This is institutional investors like banks, pension funds, university endowments, sovereign wealth funds. They use this money to acquire companies, often using a significant amount of debt. So they will do what's called a leveraged buyout. Well, they will force a company to take on massive amounts of debt, and then they will try and have that company, they will strip out all the assets from that company, and then they will leave this company with just debt that they'll never pay back. And that's why, like Toys R Us went bankrupt. That's why Toys R Us, what's another one? Red Lobster, and a lot of just chains in general. This is what happens. Why they go out of business is because they will be acquired through a leveraged buyout by private equity. So they will basically just extract as much value from these companies as possible, usually through cutting costs, which means that they'll just fire everyone, extract management fees. They will sell the real estate and the properties and assets of these companies under about a 3 to 7 year period. And when the company inevitably goes under and people lose their jobs, the pension obligations may go unpaid. The private equity firm, it retains the fees and all of the assets and all of the money. It's really, really cool. Now, if the company succeeds, it might be sold profitably and it returns flows to the firm's investment managers. Really cool, huh? So basically, the risk is socialized and the returns are privatized. Cool stuff, huh? So let's talk about where private equity has really spread. Okay, so sectors under private equity, hospitals and healthcare systems are a big one. Nursing homes and elder care facilities are another big one. Emergency medical services and air ambulances are a big one. Housing and apartment complexes, veterinary practices, and public utilities and infrastructures. So, like, why would you not want any of these to be privately owned? I am just, I don't understand it, man. Like, the woke libtards wanting public services, whatever. So the consistent pattern of things that are acquired by private equity, especially like among healthcare, is the higher prices for patients and users. They will cut staffing, especially like nurses and CNAs. There's a deterioration in quality over time. That extraction of value previously reinvested in operations, it doesn't go back to running operations. It goes to the big guys upstairs that want to make the green line go up. There's financial return for investors, but the humans are being served bare, all the costs. Like, this is your problem, right? This is not a design flaw. This is just the system functioning as intended, right? So, like, the people with all the capital get to hang on to all the returns, and you, being a stupid wage slave, you don't get any of the benefits. It's really cool, huh? Let's talk about the revolving door. Okay, so the financial industry's revolving door with the government is literally one of the most documented things that happens in Washington. So, like, the Goldman Sachs Treasury relationship alone has its own shorthand. It's called Government Sachs. So, like, Hank Paulson, he was the Treasury Secretary from 2008. He was the architect of the bank bailouts, and he came from Goldman Sachs. Robert Rubin, the Treasury Secretary under Clinton, who was the principal architect of financial deregulation, he came from Goldman Sachs. Steve Mnuchin, he was the Treasury Secretary under Trump. He came from Goldman Sachs. Gary Cohn, he was the Director of National Economic Council under Trump. He came from Goldman Sachs. This is just one bank, one firm. This extends across the entire financial industry and across administrations of both parties. The people writing the rules of financial regulations are the people who came from the financial industry and will return to it. So, like, let's take woke libtard communist government agency like the SEC. So the SEC is the Securities and Exchange Commission, is the government agency that is supposed to be responsible for regulating the stock market. But if you are getting paid like $50K to work at the SEC to regulate the stock market, but what you really want to do is you want to go work for like McKinsey or something, are you really going to crack down on the private market? So private market, when your goal is to get that cushy like $500K a year job? No, you're not going to. You are at the SEC to network, and you are at the SEC to give the people who own all the money, you want to give them all the benefits so that, once you got a couple years at the SEC under your belt, all those networking and LinkedIn lunatic nonsense, you can go over to, cush job in the private sector and make all of the money. The system is stupid. All right. Let's talk about the 2008 financial crisis again. So let's talk about the bailouts. So again, this is the system performing like it's supposed to. So the 2008 crisis, it illustrated the revolving doors consequences with like brutal clarity. So the financial institutions whose reckless lending and fraudulent securitization collapsed the entire housing market, and these banks were bailed out with taxpayer money. So the TARP funds, approximately $700 billion plus trillions of dollars more through the Federal Reserve, was used to bail out the banks for their speculative investments. Now, they got bailed out, but if you were a homeowner, your house got foreclosed on and the economy took a shit and then you lost your job. It's very, very cool stuff. So the homeowners whose mortgages were fraudulently originated and whose homes were foreclosed on, you didn't get any help. But the executives whose decisions produced the crisis, they don't go to jail. A lot of them got golden parachutes and bonuses, and some of them went to other investment banks. There was really no consequences for blowing up the entire world economy. It's really cool. So the treasury officials, like I said, like Hank Paulson, he came from the banking industry and then bailed out the banking industry. And then a lot of these people went back from the treasury to the banking industry. Again, losses were socialized, gains were privatized. Very cool stuff. So the institutions at the center, they were protected at the expense of the people that don't have the money or the resources. Really, really cool stuff. So let's talk about the Fed again, okay? So the Federal Reserve is a crisis manager and who it gets managed for. So beyond day-to-day rate operations, the Fed functions as the emergency backstop of the entire financial system. So like in 1987 with the stock market crash, the Fed flooded the system with liquidity. In 1998 with the long-term capital management collapse, the Fed coordinated a private sector bailout. In 2008, they created trillions of dollars out of nothing, by the way. In emergency lending, they bought these useless mortgage-backed securities and guaranteed them. In 2020, they turned on the money printer, dropped interest rates. They purchased corporate bonds. They supported money market funds, all that. In March 2023, when Silicon Valley Bank collapsed, they guaranteed all the deposits at all the failed banks. And this is a pattern across every intervention, right? So the financial system is always treated as too important to fail. And this pattern is so consistent across administrations, parties, and decades that it can't be attributed to individual choices. This is structural, and this is bipartisan, by the way. So let's talk about the moral hazard, that the problem and the Fed and everything, and the reason why this keeps happening, right? They are creating this self-licking ice cream cone. So the moral hazard is the tendency to take on more risks when insulated from the consequences of that risk, right? Like if I had $5 million, investing $10,000 into a sketchy stock doesn't really seem like that big of a deal, right? When I have $5,000, investing $1,000 into a stock is a lot of money. But whatever, man. Like I don't know. It's stupid. So the Fed backstops a financial system that reinforces the lesson. Like they take the risk, they capture the upside, and if it goes tits up, which it literally will never go tits up, the central bank will always intervene to help dig the banks out of the problem that they created for themselves. This is the documented behavioral pattern of the financial industry over my entire lifetime and about 2 decades beforehand. So each cycle, deregulation enables more risk-taking. There's a crisis, the Fed intervenes, the institution survives, and then the next cycle, and then the next one. They might even, pass some banking regulations, and then in a couple of years, it gets deregulated again. So the people who pay for the moral hazard, you and I, through bailouts and inflation and economic damage, like we're the people that have to pay the bill for when these institutions screw up. That's cool, man. It's really, really cool. The risks are created with those with access to capital, and they are absorbed by those without it. The cycle does not break because the people who benefit from it have political access to prevent the reforms that would break it. The moral hazard is not a bug. For those inside the system, it is a feature. Okay. So, that was the banking system, the Federal Reserve, investment banking, and all that. I hope your brain doesn't hurt too much because I wanted you to understand these systems that we've created that have kind of led to our own demise, because I'm going to be talking next about the global monetary order and American foreign policy and how this all kind of ties together.